The best of Money Matters.
Market View on Money FM 89.3.
Hi, I'm Willie Keng. You are listening to Money FM 89.3, and it's now time for Market View, where we take a look at how the Singapore stock market closed for the day, the biggest movers, sectors, and companies to watch. But first, a quick recap of how we started the day. Singapore shares began trading in positive territory as markets eased fears after President Donald Trump called for a delay of its auto tariffs on Mexico and Canada. In early trade, the Straits Times Index was up 0.07%. In terms of companies to watch, we have Mandarin Oriental, which posted an underlying profit of $74 million for the financial year 2024, down $81 million from a year earlier. And we also have Singapore's ground handler SATS expecting to invest 100 million Singapore dollars over the next 2 years to upgrade terminals in the Changi Air Freight Centre as part of plans to improve Singapore's air cargo hub. Meanwhile, Japan's 10-year bond yields surged to a close to 16-year highs on the country's rate hike expectations. Now, how should investors make of all of this? With that, let's unpack all of these developments with David Chow, Director of Azure Capital. Welcome to the show, David.
Hi, Willie. Hi, everyone. Happy Thursday.
Yeah, happy Thursday. Good to hear from you again. Now, just want to dive in straight into the Singapore market. I mean, how is the STI fared so far and what's driving markets here, David? Any surprises when it comes to the biggest movers and the sectors that they lie in?
Right after the opening this morning, I think Asia Pacific markets were mostly higher because of Wall Street rose overnight after President Trump actually postponed tariffs on certain automakers. So with that, the STI actually opened higher. But, unfortunately, as the day unfolded, risk events sort of kick in with the rate decision of the ECB later this evening. Kick in sentiment began to worsen a little, and the STI, fortunately, still closed higher at 0.5% higher. And we all know that, since August last year, STI has been really, going north, I think primarily due to the review group being formed, to look into how to strengthen, Singapore's stock market. So with that, and the recent developments on, taxes, the equity market development program and the SFO requirements all kicking in, STI should be supported in the near term. So as for surprises, with the index holding up, the banks again seem to be doing their jobs and appearing a top gainers list today. For the losers, no surprise either, but for companies which has just reported a good set of results, it's kind of frustrating in a way to see them appearing on the top losers list. Companies like iFast, for instance, kind of grabbed my attention. And if you look at the chart, it seems to me, iFast chart, it seems to me like the market was buying in anticipation of another good set of results weeks earlier and actually sold on the actual announcement. But I guess that's just a normal function of a market.
Now, just moving from iFast, going into Singapore corporate news here, there's two things which I want to zoom in here, David. One is Singapore's ground handler SATS. Look, they're expecting to invest $100 million over the next 2 years to upgrade their terminals in Changi and also to improve Singapore's air cargo hub. Can you give us an overview of this investments, these investments, and what are your views on the firm's growth outlook?
Okay, firstly on the overview first, we all know that is one of the largest ground and air cargo handlers, and with an extensive network of over 215 ground and cargo stations in I think more than 20 over countries. I think this move, first and foremost, is really to upgrade. Should be seen as an intention to further strengthen its market share, by upgrading terminals in the air freight center, and as well this will be quite useful to send a positive message to the market that is positive for air freight demand going forward, as this upgrade entails an increase of handling capacity by up to 30%, which is significant in our view. So when we're talking about the firm's growth outlook, starts as a March year, and so if you take a step back and revisit its last earnings release just a few weeks ago, it's a 3Q25 release that is. Results was a slight miss to my expectations due to a performance bonus provision issue, which is actually one-off. And if you dive right into the numbers, you can see that the group EBIT actually rose by more than 50%, and EBIT margin also underwent an expansion. Wow. So, and we could also see that its free cash flow of about 48.8 million actually swung from a net outflow of a negative 166.7 million in the prior year. So this actually underscore SATS operational turnaround and higher profitability. And I think based on earnings calls that I had with management, they also reiterated a their goal of powering down debts by about 200 million in the near term. However, despite all these positive factors in the near term, due to the various tariff that Trump has imposed to Mexico and Canada on commodities products, I think these developments will no doubt impact global trade and air cargo demand. So with the Middle East situation not stabilizing as yet, we may see a possible slowdown or volatility in the business going forward. So as investors, we have to be wary of this.
I see. Now, moving away from SATS here, I want to go into, real estate in Singapore. I mean, we have Mandarin Oriental, which recently also posted results, and they've posted an underlying profit of $74 million for the financial year 2024. Came down about to $81 million from a year earlier. What do you make of these results? And do you think its current financial results will continue to sort of drive its share price performance?
This share price, I think this stock trades on several exchanges, as some of us know, and it can be frustratingly illiquid. Despite a 2.2 billion in market cap, the Singapore main listing sometimes have non-trading activities in certain weeks. So it's really quite hard to gain a decent foothold in the stock as retail investors. And as we know, going down to business now, we know that Mandarin Oriental has transformed, from a previously asset-heavy company to a capital-light hotel management model by selling its own hotels and maintaining management contracts with the purchasers. I think with this set of results, it actually underlie the strong capability of management, as the year 2024 was a year of rather more normal pace of growth in terms of travel demand compared to earlier strong resurgence in travel demand following the lifting of pandemic restrictions. And looking specifically into the numbers, I think in the management business, I think improvement in the RevPAR performance was actually supported by strong guest demand for their ultra-luxury hotels in regions such as Asia, Europe, Middle East, and EMEA. So it's broad-based. So this is something which is good. And the own hotel segment actually also reported a stable contribution of around, I think, $45 million after tax. So with Singapore in particular delivering higher profits, followed by Tokyo, Madrid, and EMEA as well. So it's also heartening to see, the net debt, coming down significantly, decreasing, 225 million to just 94 million as at, December last year. So mainly due to the receipts of sales proceeds from some of their hotels. So I think, so for now, so far so good. So if you look at the share price again, your share price has, I think, climbed 31% from the lows of February 2024. And what will drive growth further, perhaps the next couple of years, will be the additional growth with 5 new hotels and residential planned to open this year, which will go about to support its top line growth as well. I think as there's a pipeline replenishment of 8 new management contracts, which include hotels in Paris, Amsterdam, Caribbean, and China. And moving from a shorter term to an even longer term horizon, I think management wants to double its current 41 hotels management contracts to more than double by the year 2033. So this is something to watch out for.
Oh, that's pretty interesting. Moving away from Singapore and going to the region here, I want to move into Japan. Japan's 10-year bond yield recently reaches its highest. I mean, its yield, its yield right now on the 10-year JGB has risen nearly 8 basis points, crossing 1.5% for the first time since June 2009. Its yield on its 30-year bonds also climbed 13 basis points to cross the 2.5% mark for the first time since 2008. I mean, David, what's driving its yield, and how, as investors, should we make of such movements?
Okay, I think it's natural for bond yields on the 10-year and 30 years to rise up, especially, as your market has increasingly increased the bet that the BOJ's terminal rate is rising, especially as we've been hearing quite regularly from them that they are likely to raise rates. So moreover, the central bank is also tapering its government bond purchases despite the continuous rise in yield. So this sort of added to the upward pressure. So why is the Central Bank of Japan raising rates? Well, I think inflation has obviously been rising. I think if you look at the headline inflation, it has stayed above BOJ's 2% target for 34 straight months. And with the most recent figure, I think in January, hitting a 2-year high of 4%. And even if you look at the core inflation rate, which strips out, the prices of fresh food and energy, it has also climbed 2.5% in January, which is the highest since March 2024. So with a higher inflation rate, it sort of raises expectations for everyone in the financial markets and all the stakeholders that there will be more hikes by the BOJ, hence the pushing up the bond yields.
Now, speaking of hikes here, I want to just move a bit up north into China. I mean, we have Alibaba shares now up 7% over the last 2 weeks. Shares are up more than 74% year to date after it has announced its own AI model to compete against DeepSeek. And I mean, we all know DeepSeek, how he has sort of rattled the markets here. I just want to get your views on Alibaba, on its latest AI model, the overview on the China tech stock, and the impact on tariffs on the Chinese tech sector and Alibaba itself.
Okay. I think so after DeepSeek's R1, we now have, I think, Q32B. So in the way of, and this was of course, devised by Alibaba.
Yep.
So in the way of, I think DeepSeek's emergence this year, I think we have seen multiple companies in China have trotted out models and services they claim, have matched the China startup or OpenAI. So, this is another one of those additions. I think in taking a broad view of this, I mean, yes, we think that the open source model could disrupt the industry by making the inference process more efficient and I think encourage wider adoption. But we do not think the introduction of this DeepSeek or related models will entirely transform the industry and make high-end GPUs like what NVIDIA are producing less needed. If anything, with the latest introduction, I think this has put the industry players now standing at the same sort of starting line where more training and inference process is expected starting from now. So this will go about to support more GPU demand, and it's also important to understand that computing cost doesn't mean that big tech firms will spend less on AI capex. On the contrary, they like to leverage the access to high-end chips and combine them with DeepSeek's technology to try to widen the gap between US and China AI technology. So, as an example, if you think about how Japanese low fuel consumption car capture half of the North American markets back then, and when we also have Xiaomi reduce the price of smartphones from 5,000 renminbi to 1,000 to close to 2,000 renminbi, a couple of years ago, all these have prompted demand for more products. So I will expect DeepSeek's introduction to be likewise as well. And on overview of China tax plus tariffs, while DeepSeek's innovation is a milestone, I think China's long-term AI trajectory will ultimately depend on whether it can break through its semiconductor manufacturing choke point. While China's AI, I think, applications are evolving rapidly, the chip makers still have a long way to go before they catch up. And I think the U.S. robust semiconductor supply chain will continue to reinforce its AI dominance, at least for the foreseeable future.
Wow, I think it sounds pretty optimistic here. Just one more question before we let you go, David. I mean, with the recent China stock rally, the positive news coming out from China tech stocks, what do you make of China tech valuations? Do you think they are cheap still or getting a bit more expensive here? Again,
the market has run ahead of themselves, and while the strong positive sentiment has already driven a rally in China semiconductor stocks and the related players in the whole ecosystem, and this momentum could continue in the near term. However, the sharp prices increase has really outpaced the fundamental improvement, and I would suggest that investors should be more cautious about the sustainability of these gains.
I got you, David. We have been speaking with David Chow, Director of Azure Capital. Thank you so much for your insights, David. Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.